Hey everyone, welcome to QuantSreet's News and Analysis Podcast. This is your host Mahir welcoming you to the latest episode of QuantStreet. Good morning, good afternoon, good evening from wherever you are listening. And here are the major economic updates for today. Unemployment rate drops to well under 10% by David Henderson from EconLib. In August, the unemployment rate declined by 1.8 percentage points to 8.4%, and the number of unemployed persons fell by 2.8 million to 13.6 million. Both measures have declined for 4 consecutive months but are higher than in February by 4.9 percentage points and 7.8 million, respectively. This is from the Bureau of Labor Statistics Economic News release on September 4, 2020. Another highlight is that the labor force participation rate increased by 0.3% to 61.7% in August but is 1.7% below its February level. Total employment as measured by the household survey rose by 3.8 million in August to 147.3 million. The employment population ratio rose by 1.4% to 56.5% but is 4.6% lower than in February. It's not all good news. Employment in government increased by 344,000 in August, accounting for one-fourth of the over the month gain in total non-farm employment. A job gain in federal government plus 251,000 reflected in the hiring of 238,000 temporary 2020 census workers. Local government employment rose by 95,000 over the month. Overall, government employment is 831,000 below its February level. But there is good news for hapless hospitality workers. Employment in leisure and hospitality increased by 174,000 in August, with about three-fourths of the gain occurring in food services and drinking places, which is about plus 134,000. Despite job gains totaling 3.6 million over the last 4 months, employment in food services and drinking places is down by 2.5 million since February. Moving on, the next story we are tracking is the easy part of the economic recovery might be over from 538 by Amelia Thompson DeVoe, Neil Payne, and Julia Wolf. Is the economy finally starting to rebound? Based on the headline numbers from the August jobs report, things sure look that way. The report shows that the economy added 1.4 million jobs in August, and the unemployment rate fell below 10% for the first time since March to 8.4%, down 1.8% since July. Good news, right? Well, when it comes to the jobs report in this pandemic, looks can be deceiving. The economy is certainly improving. The August report shows that the labor force participation rate increased a bit and millions more furloughed workers returned to their jobs. But there's a bunch of clues in this month's report that the growth we're seeing now isn't as robust as it looks, and that it probably isn't sustainable without a dramatic change in the public health conditions. A significant chunk of the jobs gained in August were added thanks to a once in a decade phenomenon that has nothing to do with the current recession, a slew of temporary hiring for the US Census. Private sector job growth is slowing overall, and the industries that were hit hardest by the pandemic, like leisure and hospitality, appear to be stalling out well below their pre pandemic peak. Getting people back to work will likely be harder and harder in coming months because a growing share of unemployed people have lost their jobs permanently. The recovery is arriving faster, but for some groups than others, which means that the workers of color in particular are still suffering much higher levels of unemployment than white workers. Trump can thank census for this month's positive headlines. A lot of credit for this month's better than expected job numbers should go to the US Census Bureau. Every 10 years, the Bureau goes on a hiring spree, bringing hundreds of thousands of workers onto its payrolls to fan out across the country for a few months, knocking on the doors of people who haven't returned their census forms to ensure the count is accurate. In a normal year, the sudden spate of hiring would be extremely noticeable. Several hundred thousand new government jobs could increase the month's total number of jobs gained by an order of magnitude. But the COVID 19 recession has thrown our frame of reference out of whack. Because we have lost tens of millions of jobs in March and April, it doesn't seem weird that we would be gaining well over a million jobs in a single month these days. So the addition of 238,000 census jobs in August wasn't as obvious as it ordinarily would be. Instead, it's quietly padding the total, but census hires accounted for fully 17% of total non-farm jobs added in August. And more importantly, this uptick is extremely temporary. Most census workers will be laid off when canvassing for the count ends later this month. The private sector is less of a success story. It's also important to remember that we're still very, very deep in the hole we fell into in April, and that job growth in the private sector is slowing. While government employment rose by 1.6% from July to August, Again, fueled in large part by Census Bureau hiring, private sector employment was up only 0.9% over the same period. After a similar 1.3% gain in July, this may signal that private hiring has hit something of a plateau. That's corroborated by data from job search sites such as Indeed, which also shows a slowing trend of job listings after steady gains earlier in the summer. The job gains are slowing down fastest in industries that were hardest hit by the pandemic, which means it could be especially difficult for those industries to make back to their pre pandemic levels. For instance, the leisure and hospitality sector lost a staggering 8.3 million jobs in March and April, but after quick gains in May and June, the industry only added 621,000 jobs in July and 174,000 jobs in August, leaving it 4.1 million shy of its pre pandemic February 2020 baseline. And that's true of essentially every major industry in America through late summer. Every economic supersector except mining and logging saw job gains in August, and all but a few made gains in June and July as well. Yet, every one of them also employs fewer people now than it did in February. The closest to normal is utilities, which is down 1.3% from before the pandemic, but the median supersector is down 6%, with some industries like leisure and hospitality down as much as 25% from pre pandemic levels. Nick Bunker, the Director of Economic Research for North America at the Indeed Hiring Lab, a research institute connected to the job search site Indeed, told us that the slowdown in leisure and hospitality is especially concerning because it could indicate that as long as it's operating under pandemic conditions, the beleaguered industry could be running out of new jobs to add. For me, it's about figuring out when we've moved out of the rebound stage into what looks more like a typical recovery from a recession, where there are steady gains but not a huge surge in employment. He said, this month's job numbers indicate that we could be reaching that point, which is quite alarming given how far below the pre pandemic peak those industries still are. A permanent problem. One thing that economists feared earlier in the summer is coming to pass. The number of people who had permanently lost their jobs rose last month, even as lots of temporarily unemployed workers were returning to work. According to the BLS, 9.2 million workers had been on temporary layoff in July, which was similar to the number from June, 10.6 million, but only 6.2 million fell into that category in August, meaning 3.1 million furloughed or otherwise laid off workers went back to work. That's the good news. The bad news is that the number of people who had been permanently laid off did not see the same decline. The group actually grew from 2.9 million workers in July to 3.4 million in August. On the one hand, 64% of people who lost their jobs were categorized as temporary layoffs, which is down dramatically from earlier in the pandemic. It was 90% in April, and is more in line with the numbers from before the crisis. The share in February, for instance, was just 39%. But with unemployment still quite high by historical standards, this also means it will be increasingly hard for people who are now permanently unemployed to find jobs. We have a slow moving unemployment crisis coming, said Martha Gimbel, an economist with Schmidt Futures. We saw this happen in the last recession. It took many people who lost jobs an incredibly long time to come back from that. The share of the workers in part time jobs is also increasing. In August, 17% of people with jobs work part time. In a way, this too is more in line with the normal economy. The share in February was 17.5%, but the reason so many workers are taking part time hours speaks to one of the biggest economic issues of the pandemic: childcare. When the BLS lists workers by full time or part time status, they also track whether the status is due to economic reasons, like a slowdown in the industry or slack job market, or non economic reasons. Right now, 71% of all non agricultural part time workers fit the latter category. And one of the biggest non economic reasons that people look for or accept part time work is childcare obligations. We know that even under normal circumstances, about one third of women who have young children and work part time do it because of caretaking duties. With in person learning at schools still curtailed in many areas, it makes sense that this would factor into an even greater rise in the part time work, simply out of necessity. The recovery isn't helping everyone equally. Meanwhile, the recovery continues to arrive more quickly for some people than for others. This month, the unemployment rate for the white workers fell to 7.3%, down 1.9 points from July, but workers of color continue to struggle with much higher levels of unemployment. The unemployment rate was 13% for black workers, 10.7% for Asian workers, and 10.5% for Hispanic workers. The gap between black and white workers is especially concerning. It's unfortunately normal for the black unemployment rate to be much higher than the unemployment rate for white workers. That was true earlier this year when times were good, and it was also true during the Great Recession. Since the current recession started, the black white unemployment gap has actually been smaller than it was during the Great Recession, when black unemployment peaked at a stunning 16.8% in March 2010, while white unemployment was much lower at 8.9%. But that's in part because black workers, particularly black women, tend to be overrepresented in jobs that have been deemed essential during the COVID 19 pandemic, which meant they may have been insulated from some of the dramatic job losses in April and May. As workers start to be rehired, though, both Bunker and Gamble told us that they expect white workers to be called back more quickly thanks to employers' intentional and unintentional racial bias. Black workers tend to be the first to be laid off and the last to be hired, Bunker said. Unfortunately, this is a factor you see in lots of recoveries. It takes a very strong labor market to get the black unemployment rate down to levels that would be acceptable for other groups. For instance, this month, the unemployment rate for white women fell by 2.3 points, one of the largest drops of any demographic group. But for black women, the decline was much narrower, only 1.3 points. This disparity is troubling on a number of levels. It's telling, first of all, we've grown so accustomed to high unemployment rate among black workers that the current disparity isn't all that surprising. And moral considerations aside, Gimbel said, unevenly distributed job gains can turn into a drag on the economy. Race-based job discrimination, whether it's deliberate or not, means that the person who gets any given job may not be the most qualified person for that position. Then you have to remember that those people are also consumers. Gimbel said, they spend money, so if they don't have that money to spend, that holds us back too. All of this is a reminder that the recovery continues. There'll be a lot that the headline job numbers can tell about how the recession is being experienced by different groups of people. Some industries are rebounding faster than the others. Some people are much likelier to benefit from the rallying economy than others. And if the recovery is indeed starting to slow down, those inequalities could be with us for a very long time. With that, we come to an end of this episode. This has been your QuantStreet news and analysis briefing. Check back on this channel for more such stories. And thanks again for listening. If you enjoyed the thoughts on the economy, please take a moment to rate and review us on the podcast app of your choice or YouTube and help more people find the show. The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.